Welcome to this explainer on the Income Tax Out 2025. If you're a practicing chartered accountant, a business owner, or a student gearing up for exams, you know that mastering the new tax code is absolutely crucial. Today, we're unpacking the brand new consolidated provisions for minimum alternate tax and alternate minimum tax, all sitting right under Section 206. Let's kick things off with a practical scenario. Picture a massive corporate entity declaring huge dividends to its shareholders. Their balance sheets look incredibly strong, yet their regular income tax liability is almost zero. How is that possible? Well, through entirely legal exemptions and deductions. But how does the tax system ensure these highly profitable entities still pay their fair share? That is exactly where minimum tax provisions step in. In today's explainer, we're going to systematically navigate through Section 206. We'll introduce the law, break down the mechanics, walk through a real-world taxation example, cover the new compliance forms, tackle transition issues, and wrap up with the key takeaways. All right, Part 1, Introduction, the shift to Section 206. If you've been practicing a while, you remember the old 1961 Act. We had to juggle Section 115JB for MAT, 115JC for AMT, and constantly do that mental gymnastics between the previous year and the assessment year. Well, the 2025 Act simplifies this beautifully. It rolls everything into one powerful section, Section 206. And the best part? The whole assessment year concept is completely gone. We are now working with a single, streamlined tax year. Moving on to Part 2, breaking down the legal provision. Let's dissect how this actually works. First up is the minimum alternate tax, or MAT. This applies strictly to companies. Think of it as the government's statutory safety net. If a company claims so many deductions that their normal tax liability drops below a certain threshold, MAT steps in. They'll have to pay a minimum tax calculated on their book profit instead of their regular taxable income. Basically, it's the profit on their P&L account, just tweaked with some specific statutory adjustments. Then we have the alternate minimum tax, AMT. This is the exact same concept but for non-corporate taxpayers like LLPs, partnership firms, or individuals. But here, instead of book profit, we use what the Act calls adjusted total income. That's basically your regular taxable income bumped back up by certain deductions you claimed. It just makes sure everyone pays a baseline level of tax. Now, you might be wondering, does everyone have to pay this? Actually, no. The law provides some very clear exemptions. For instance, companies are totally exempt from MAT if they've opted into the new tax regime. And for non-corporate folks like individuals and HUFs, there's a massive relief threshold. If your adjusted total income is 20 lakh rupees or less, you are completely exempt from AMT, not a single rupee owed under this section. Another big upgrade in Section 206 is the automated rate structure. The new filing system actually selects the correct rate for you based on the entity. For most non-corporate taxpayers, the AMT rate sits at 18.5%, but cooperative societies get a nice concessional rate of 15%. And if you're dealing with specific units in an international financial services center, an IFSC, earning exclusively in convertible foreign exchange, they get a highly concessional rate of just 9%. All right, Part 3, a practical taxation example. Let's ground all this theory in some actual math, because as tax pros, we need to see the numbers. Let's say a company calculates its normal tax liability after all deductions and its 10 lakh rupees. But when they calculate MAT under Section 206 on their book profit, it comes out to 15 lakh rupees. The law says you pay whichever is higher, so the tax payable is 15 lakhs. But here is where the system is actually pretty fair. That extra 5 lakh rupees you paid isn't just gone. It immediately becomes a MAT credit. This credit mechanism is brilliant because it prevents double taxation over a business's life cycle. Step 1, you pay the higher minimum tax today. Step 2, you carry forward that extra amount as a credit. And Step 3, in a future tax year when your business cycle shifts and your normal tax is higher than your minimum tax, you literally just use that stored credit to knock down your final tax bill. Let's jump to Part 4, Compliance and the New Forms. Knowing the law is great, but compliance is where the rubber meets the road. And under the Income Tax Rules 2026, things look a bit different. If you remember the old forms, Form 29B for MAT and 29C for AMT, you can go ahead and forget them. They are officially retired. We are now working with Form 66 for companies calculating MAT and Form 67 for non-corporates calculating AMT. Let's zoom in on Form 66 for companies.
Filing this is mandatory if your normal tax drops below MAT. And here is a real game changer on the new portal. Form 66 pulls pre-filled data directly from the ITR. This is huge for avoiding those annoying mismatches and processing errors. Plus, it bundles all those old, clunky annexures into one clean report. But don't let the automation fool you. It still absolutely requires independent digital certification by a practicing chartered accountant.
Similarly, Form 67 is your go-to for non-corporate taxpayers. It is fully digitized now. That means no more physical rubber stamps or wet ink signatures. Authentication is done entirely via secure electronic signatures from the verifying CA. And you'll notice a running theme throughout the form. It strictly uses the new tax year terminology. Which brings us nicely to Part 5, Common Practical Issues and Transition Rules. Whenever a new act drops, the transition period is a bit chaotic, so let's clear up the biggest hurdle, the terminology. You have got to unlearn the assessment year. Under the 1961 Act, income earned in previous year 23-24 was taxed in assessment year 24-25, which honestly confused a lot of people. Under the 2025 Act, the year you earn it and the year it's assessed are the exact same thing. It is just the tax year. All your software, forms, and client emails need to reflect this immediately. Now for the million-rupee question clients keep asking. What happens to my old MAT credits? Are they gone? The answer is a resounding no. Under the transition provisions, any unutilized credits from the old sections 115JAA or 115JD are fully protected. They seamlessly transition to the 2025 Act and can be carried forward for up to 15 years from where they were first available. Just keep in mind, you can only use these credits to offset actual tax, never interest or penalties. One last practical tip on calculations. Do not forget your statutory accounting adjustments. When you're computing book profit under Section 206, you still have to carefully factor in depreciation. And if you're dealing with large companies converging to IND AS, Indian Accounting Standards, there are specific transition amounts, usually spread over 5 years, that you must adjust to keep the MAT calculation completely fair. And finally, Part 6, Key Takeaways. We've covered a ton of technical ground today, so let's lock in the 5 absolutely crucial points. Number 1, Section 206 is your brand new consolidated home for both MAT and AMT. Number 2, update your firm's checklists. It's Form 66 for companies, Form 67 for non-companies. Number 3, the portal's automatic rate classification is great, but always double-check your entity type. Number 4, breathe easy, those legacy tax credits are legally protected for 15 years. And number 5, even with all this automation, the chartered accountant's role is more vital than ever. Digital certification is strictly mandatory. So the real question isn't just about filing forms anymore. It's about strategically planning your client's transition to maximize those 15-year carry-forward credits. Are your clients' books ready for the shift? Thank you for watching. Please like, subscribe, and share. This video is for educational purposes only and does not constitute professional advice. Tax laws are subject to amendments. Please consult your professional advisor before taking any action. This is an AI-generated educational video.